All right. Hi there. I'm Christian Peter. I just wanted to go ahead and get started here. We've got about 15 minutes or so. I wanted to go through a quick presentation. This is real estate investing, multifamily apartment buildings. I am a real estate investor. I've been buying and selling properties since 1994 and created this meetup group about 3 years ago or so, mainly focused on real estate investing, short-term rental properties. And now we've gotten more into multifamily apartment buildings in the last year or so. So I wanted to share some of this with you guys. I'll go through a couple of samples of what we've been doing, some of the risks involved with multifamily investing as well. And then at the end, we can kind of discuss if you guys have been buying and selling apartment buildings or duplexes, fourplexes, and what the market looks like in different areas of the country. So let's jump right in. So when you're buying and selling any type of investment property, it's always DIY, do everything yourself, or syndication. We've been syndicating a lot of our properties now, especially the ones that are ranging from about $5 million to $8 million and raising funds in order to go out and purchase those apartment buildings. When it comes down to finding the investment property, you can always go to LoopNet, Crexi, some of the portals that are out there and allow you to get an idea what's available in certain areas of the country. Then it comes down to finding the right price and terms, negotiating with the listing broker, whoever's involved. Once you've got under contract, getting all the inspections, repairs, everything financed. If it's going to be cash, setting up the cash, getting your property management in place, depending on where the property is located, what type of capital improvements are needed, organizing the construction, contracting if it needs to happen, doing the right cash flow analysis, knowing what the property is worth today and what it can be worth, either by increasing the rents or decreasing the expenses. Obviously, the whole goal with any type of investment property is to increase the return on your investment, the net operating income, which is going to be the main driver in any investment property. And then at the end of the day, do you want to get it in to shape to refinance that property, take most of your capital out, or to sell it, realize those profits, and move into the next investment? When it comes to the syndication aspect of it, we've been doing a lot of syndications lately with investors that are in our area and other people throughout the country, where we get minimum investments of about $25,000. Everybody gets a percentage ownership in the LLC. The profits and are distributed to the investors each month. And then at the end of the year, the accounting team creates the 1099s and K1s go out to everybody. So the investment goals and the syndication objective is to find the right property with the biggest upside that you possibly can, to leverage it so that you're increasing the returns and hopefully taking advantage of the low mortgage rates that are out there right now. Improving the units, increasing the rents, leveraging the management and reducing the expenses, and of course, increasing that property value, at which time you can eliminate any risk by refinancing and taking most, if not all, of your capital out. So previous examples, the last one that we just purchased was $2.9 million. We got a $2.3 million loan on it, had about $1 million of syndication financed, syndication raised cash, did about $400,000 worth of improvements to the property, which increased its value to $3.5 million. So the actual investor equity went up by about $200,000 just by doing the improvements and adding the value to the property. So the investment returns, what we're looking for is, when we have a investment property that we're purchasing, in case like the last one, we had $1 million that was invested. For just sample purposes, I put each investor at $100,000, so there'd be 10 investors. Everybody's getting a 8% preferred return on that, so you're getting $8,000 annually and 60% ownership overall of the LLC. The nice thing about investing in real estate, as most of you probably know, is the depreciation factor. So almost all of the distributions and income that you make from it are tax deductible, if not tax free, depending on the tax basis of the property. So as an individual example, I kind of put this together. It's a lot of numbers, but if there was a sale of a property and you invested $100,000, we're receiving about $8,000 a year, which is about $667 a month. After the 5 years, you'd have about $40,000 in income. The property appreciation based on about 5 years of, 5 years with 5% appreciation per year in rents would increase the property value to about $4 million. If the loan was 2.1, the equity that's going to be there is going to be about 2.5. So you're going to have a return on your ownership of about $88,000 plus the $40,000 in income, which is going to be about 128% return over 5 years, which isn't too bad. The ideal scenario that we like to do is to cash out and refi after the property is appreciated in value, which means we've increased the rents, decreased the expenses enough in order to be able to cash out all the investors and basically allow everybody to have infinite returns. The way that happens is if you've received all of your principal back, so you've invested $100,000 and you've gotten that $100,000 returned to you, you're still receiving those distributions from the cash flow of the property forever, and you can sell your LLC ownership at any time. So what are the risks associated with it? Obviously, the value goes down. Why does the value go down? Typically because rental rates are either decreased or, as we've had recently, the evictions moratorium and the COVID has caused an upheaval in the market, which has created opportunities as well because there are some distressed assets where people aren't paying rent or the rents are a lot lower than they probably should be. There's external factors that may come into play and the property may need to be held for a longer time frame. With most investment properties, multifamily, 5+ units, there's a 25-year time horizon on most of the financing that you'll find. So you're looking at 25 years to have the property and own it free and clear. The nice thing is that the cash flows and the write down in the loan amount is going to create a much you're going to have basically a free and clear property after those 25 years. The depreciation, which is tax deductible, also needs to be reclaimed. So if the property is ever sold, then obviously there's a big tax implication associated with that. If you do own a portion or the whole LLC, selling that could be a risk as well because it's a privately owned company. But you're also allowed to sell that interest at any time. So our syndication is apartmentsinvestor.com. We offer the passive income that I just responded to with the slides that were involved. We have a couple of properties that we've worked with, and my partners and I have been doing this for over 20 years a piece. I work with a real estate attorney here in San Diego who I'm going to have on the next meetup call. And I have a CPA who we also work with here that we'll probably have on next month as well. So what are the next steps? Well, I'd like to thank everyone who was on this meetup. Please make sure to put a review in the meetup. It helps obviously the meetup grow. Take action always. Look for potential investments that are out there, even if you don't have the ability to purchase a large apartment complex on your own. There's always the ability to syndicate it. That's what we do, and happy to work with anybody that has something that they've either found or that they think might be a potentially great investment. Buy what you can, especially in this amazing real estate market that we're in. Taking advantage of the interest rates that are in the threes right now has created a rush of people to get into whatever they possibly can when it comes to real estate investing. But there are still deals out there to be found, and a lot of these apartment buildings, especially in B and C class areas, cash flow extremely well. Then obviously repeat and relax and enjoy the profits that you get. I put my email address there at the bottom so that if you guys have any questions or you need anything directly, you can feel free to email me anytime and let me know if you're investing in the market, what things look like, if you've got projects that you're working on. I always love networking with like-minded individuals and finding deals throughout the country. With that, I'll just wrap it up and kind of open it up to questions. If you guys have any questions or so, we can kind of go on for about 10 more minutes here.
I have a small multifamily. My name is Danny.
Hey, Danny.
Yeah, hey. Thank you for putting this on. I was so excited to go to this, but it looks like I must have gotten the time wrong. Did it start? I thought it was 5 p.m. Pacific. Is that not the case?
Yeah, it was 5 p.m. Pacific. Are you in Pacific time?
I am. Okay, so it was a quick one. I had 5 to 6, but
Yeah, usually I try to go for about 15, 20 minutes and then open it up to questions for the last 10 minutes or so. And it's, it's only usually about 30 to 45 minutes as a total.
Gotcha. Okay. I had some issues with the Zoom link, but anyways, I'll be more prompt on the next one. Yeah. But yeah, I've got a small multifamily, looking for a larger one. I feel like I kind of got my feet wet. I'm like, okay, this is doable. Looking for now a larger one, pretty much nationwide, and was very interested to hear any kind of market analysis if there are interesting areas people are excited about. I'm not shy on the phones. I do a lot of cold calling to lists that I kind of am making myself through that prop stream tool. So yeah, just here to learn more. And if there's some interesting markets for kind of maybe like small commercial multifamily, 4 units to maybe 4 to 50-ish is what I'm interested in now.
Great. Where do you own your current, how many units is it?
Yeah, it's 2 units in Santa Barbara, California. Okay. And I'm adding a third unit right now with the ADU law.
Great. Yeah, Santa Barbara's a nice high rent neighborhood.
It's great. Yeah, I love it. I grew up here, and it felt like a good way to kind of get in for me, not having a background or not, yeah. So I've had a great experience so far. I've had this for 3 years, and it's doing well. And adding now, going on the development adventure with this, I'm doing a 3-bedroom, 2-bath ADU. So like a larger one.
Excellent. How's that going? Is it going through the city of Santa Barbara? Are they giving you any hassle?
Not. I mean,
I think I'm on mute.
Oh, I think somebody just popped off mute, but it's been okay so far. I actually got a permit for a smaller one last year, and then right before I poured the foundation, I decided I want to go got a permit for a studio, and then I decided, let's go for a 3-bed, 2-bath because I have the space for it. So I do have to get a solar access height modification, but it seems like it'll work out. I talked to the planning staff, and I think we've got a good avenue. And if we don't, they told me I can just chop off this corner of the building. So. Yeah.
Excellent. Well, what I've been doing and we've been doing is finding usually 20 to about 60 to 70 units in kind of the B class areas, mostly in Texas, Arkansas, Tennessee, and obviously the cash flows are a lot different in the B areas than they are in California, your Florida, your New York. And what we've been doing is syndicating the actual projects to a group of investors that we work with here in San Diego mainly, but the meetups hopefully to get more people interested and also to find other deals throughout the country. We work with people and try to get at least an 8% preferred return up to a 12% preferred return, and then look for value added opportunities, right? Things that we can buy for, a couple $1 million that 3 to 5 years from now are going to be, double in value, hopefully.
And how does the equity position shake out? I'm just, for the record, I have not done a syndication, so I'm not sure exactly what the terminology is. But yeah, what does the equity play look like for like a limited liability investor kind of? Are they LLCs or what are they?
Yeah, like? Everything's an LLC, and my partners here, one of them's an attorney and one of them's a CPA, so everything's done easily. I'm kind of on the investment side of it. I've been doing most of the brokerage business for over 20 years now. But yeah, the waterfall, the way it looks is that all of the investors are returned their capital ahead, and then the waterfall is usually 60% of the LLC is distributed. The profits are distributed to all the limited partners, the investors, and then the 40% that's left over goes to us if everything goes well at the end of the day. So it's worked out pretty well. My business partners have been doing this type of syndication longer than I have. I just joined up in about 6 months ago, and we've bought 52 units in the last 6 months, but we're really looking to ramp up operations here in the next 6 months and towards the end of the year here and get 3 to 4 more apartment buildings either closed or under contract, and then next year hopefully have about 6 to 10. So we're hoping to get about 200 or so units each year for the next 5 years, and then we'll see where the real estate market goes. But with the cost of building and all the commodities that have just dramatically increased in value, I don't see the value of anything coming down anytime soon, and rents continue to go up. In fact, rents are still a little bit depressed as compared to property values throughout the country. So I think the rental values will go up dramatically here in the next couple of years as they try to catch up to this 14% increase in property values across the country. So it'll be an interesting time to see what happens when it comes to the overall value, especially of new construction. There's going to, as apartment buildings cost more and more to construct. And I'm finding that through a lot of my friends that do development projects from the ground up. And you've probably seen that on your ADU. The cost of everything obviously is increasing dramatically.
Yeah, 100%. Yeah, it's unfortunate for somebody looking to develop something right now.
Yeah.
Are you guys planning on holding them 4 to 6 years, or is there a planned hold and then disposition timeline?
Yeah, most of the loans for the commercial properties, 5 units and above, are 5 years. Some are 7 to 10, but usually the best terms are the 5 year. They're fixed for 5 years, and the financing that we get right now is about 3 3/4. As low as probably 3 5/8 right now. So that's fixed for the 5 years. Then after the 5 years, we're trying to put them all in position so that we can refinance them somewhere, in that 5 year time frame, take everybody's principal out, and then at that point, it becomes a risk-free investment at everybody, and then it just, the profits get distributed accordingly. So that refi goal is the big thing that we always look for. So taking a property that's $3 million and getting that $4 or $5 million value out of it as quickly as possible, so that once we refi, we can just distribute, the $1 million or so that it costs for down payment and value add to get into the project. And then at that point, people can decide if they want to sell their LLC interest or if they just want to continue with that passive cash flow for a long time.
Very cool.
Also found that, like, with people like you that have, they probably have seen a lot of appreciation. Some people own single family, some people own a duplex or a fourplex, and they've seen their values go up dramatically over the last couple of years. But their rents obviously are not, the cash that they're throwing off is not the same or on par with the value. So say that your $500,000 house went up to $800,000, and now you've got $300,000 plus of equity in it, but your rents you're still getting are $3,500 a month. You could cash out of your single family, take that money and 1031 it into the syndication, and continue to get passive income. Still realize that appreciation from the actual commercial apartments, and not have any management headaches or other things that go on with that. So it also insulates people from any type of a real estate correction that would happen in the single family or the residential market.
Makes sense. No, yeah, basically take it out at the super low rates right now, like with a HELOC or something. Like, I'm taking out some of the equity with a HELOC because my first is so good. I'm at the conforming loan limits. The HELOC was the way to get it out, and I'm going to put that into the ADU because it's basically like 18%, 20% cash on cash return when you look at the rental. So, but then doing the same thing, I think, yeah, if you didn't have an option to do an ADU, or if you didn't want to, I think that's a great option. Makes sense to me.
Yeah. So that's always another option as well. I've had 2 clients that have sold, their investment properties now, and have taken the $300,000-$400,000 and 1031 it directly into a syndication, not have to pay the, in California, it's we've got 50% basically taxes on just about everything. And
but they sold them. They decided to just fully sell instead of doing some kind of like cash out refi or like a HELOC or something like that.
Yeah, I think that most individual owners don't want to deal with, tenants right now, especially, and just the cash flow they're getting might be a couple $100 a month, or they could get a couple hundred, if not a couple $1,000s to take that cash out, put it in the syndication, not have any, tenants, toilets, or headaches, and then still be able to see the appreciation from the real estate, but not have to have any of the worries of it going down or having to maintain it or all the other things that happen. So I think that that's an option for a lot of people. I know that with the appreciation that we've seen here, it doesn't feel like it's going to end, maybe this year, but at some point, 13 or 14% year-on-year appreciation is gonna reverse, right? We all saw it in 2004 and 5, and part of 2006, and then it happened pretty quickly in the end of 2006, 7, and 8. It was a pretty dramatic change when it does change and go and turn around. The nice thing about having multifamily stuff is that you're pretty much insulated from, when one thing drops, everything has a tendency to go down. But when you have cash flows that are coming in, especially from renters that need a place to stay, if anything, the apartment demand goes up. The rents tend to stay pretty stable. They may decrease a little bit, but they tend to stay pretty stable, especially if they're, a step below those A-class apartments. Maybe they're B or C class, so they're a little bit less to begin with. So you're really insulated from, your $800,000 single family house dropping to, 500. Your apartment building may go from, 3 million to 2.8, but it's all based on, NOI at the end of the day, your net operating income. So as long as your NOI is staying pretty consistent, the value of your building is not going to go down too much.
Yeah. And you may have covered this earlier. Are you guys seeing, I think you said in the notes for the meetup around like eight caps were what you were seeing in some of these markets. Is that still the case? I'm not sure how old those notes were.
Yeah, that's the case. So the last building that we just bought was at 8.1. The one before that was a 7.7. So they're really, they're really good as far as cash on cash and internal rates of return that we're getting. But and in California, you're lucky to see anything above a 4, right? I mean, most of the things now are in the 3s, and it creates you still have the speculation that they're going to go up in value, but that's really what you're doing if you're buying something with a 3 cap, is you're just speculating that you can potentially add value or it's going to go up in value over time. Whereas when you're buying an 8 cap, all you have to do is increase rents every year 3%, and you're gaining a lot of value over that. So I like the properties that are, the sweet spot is between $3 and $6 million, and usually between 20 units and 50 units. The things that the REITs really don't want to get involved with because they're too small, but they're a little bit too big for the owner occupant or the owner manager that just doesn't want to deal with 30 different tenants, and that's where we found a really good niche, especially in some of the off markets like Little Rock, Arkansas, and Huntsville, Texas, and Knoxville, Tennessee. Is you get a pretty decent. You can find the diamonds in the rough in the smaller markets.
Yeah, and I'm not familiar with those markets. I mean, I know those names, but are they like adjacent to more of a metro area? Is that kind of your criteria, like adjacent but not the actual metro area?
Yeah, we're looking for things that are within a 45-minute drive of a major metro hub.
Yeah,
you've got to have an airport. You've got to have you got to have your employment hub. You've got to have resources that are close enough. So if you're 20 minutes from, or an hour, say, from Houston, or if you're an hour from Nashville, or Little Rock is its own pretty large city with a pretty good base of college students and industry as well. So when it comes to the major metro areas, you don't want to be in downtown Austin unless you're going to be paying a 3 cap again. But if you're 45 minutes outside of Austin, you might be able to get a 7.5 cap, and you're still being able to capture a lot of those people that couldn't afford to live in downtown Austin, but they still want to be in the area.
Yeah, I wonder, what do you think happens to those? I'm just going to say like outskirt areas. I wasn't here through the last correction. I was in school, so I didn't live through it. I don't know what happened. Like, what happened to those? Because it kind of seems like, okay, the metro areas are growing. They're doing super well in this period of growth in the general economy. That spills over into the outskirt areas, and then they're growing too. It seems like driven by the metro area success. Did that act like, how do those skirt areas do in like a correction time? Like, not even as serious as like an 08, 09, but like a contraction. What is your guys' philosophy thesis on how that effect will be on the outskirt area, like a Little Rock? Or
it's a good question. Yeah, what you're looking at though are two different types of properties, two different types of investments. If you're looking at just plain residential investments, you're exactly right. You want to be as close to downtown as you possibly can be in order to maintain some type of value in a correction. So if you're in downtown San Diego, you're still going to see a correction in prices, but you're not going to see as dramatically as if you lived in Santee, which is 30, 45 minutes outside the city. And you're going to see that with any type of residential correction. The closer you are to the beach, you're going to be kind of the last ones to get hit and the first ones out. But when it comes to real estate, as we know, it's like, okay, what's desirable in a certain time frame. And when it comes to the commercial side, apartments especially, when people are forced to leave for whatever circumstance and go from something that's more expensive to something less expensive, they're usually going to choose, you've got apartments or mobile homes on the bottom of the food chain when it comes to shelter. So the values tend to hold a lot better than in the residential side, where even in San Diego and most of the areas, even downtown, prices went down 50, 60, 70% in some neighborhoods.
And the rental rates, you feel like will stay relatively stable even through a correction in these commercial properties, like maybe at 15, 20%. Maybe they might even not go down as people, if you're saying people would be fleeing
yeah, well, what we've typically seen is that when it comes to a change, so a downturn or whatever, people are going to downsize, right? And they might be forced to for whatever reason. They might lose their home to foreclosure, or they might just not be able to afford their mortgage or their higher rent payment, right? So they're going to go look for something that's going to be a less expensive alternative, either a different area of the country, or if they're forced to stay in a specific area, they're going to look for whatever they can find that's going to be the least expensive option. So when it comes to commercial properties, they're going to, especially apartments, multifamily things, are going to hold their value a lot better than the single family properties will. When it comes to the depreciation or the distressed portion of the market, there's not going to be a whole lot that's going to be for sale, because people are going to be leaving their homes to go to apartments or mobile homes or that type of thing. So yeah, the downturn in especially in 08, 09 saw so many people losing their homes, but the commercial market wasn't hit as hard because they were going to to apartments, and people were actually building apartments because there was a huge demand at that point. So yeah, we do see that the value should hold up a lot better when it comes to the larger scale complexes than for the single individual properties.
And why would, and I want to give anybody else a chance to ask a question. I feel like I've been really hogging the mic here, but that's maybe the last question I'll ask her. This guy, like this, the guy you guys just got this 52 unit or so from, if they're selling it to you at an 8 cap, like, motivation for selling something like that, if it seems relatively contraction resistant, it's spitting off great cash flow, what's letting go of that? Are they 1031ing into something bigger? Or
so what we're always looking for opportunity. So there's opportunity when it comes to the properties that we're buying. The last one that we bought was 4 people that were in a partnership, and the partnership just wasn't working out, right? 3 of the guys, they wouldn't get along with the 4th guy, and the 4th guy was pissed off, and they had to sell the property basically.
Wow.
They gave it to the broker. He listed it. They got a couple of offers. Ended up accepting one. It fell out of escrow because they didn't end up closing. And after being on the market for about 180 days or so, we ended up buying it for about $300,000 below what it was probably worth and what it was initially listed for. But they just wanted to get rid of it, be done with their partnership and move on. And there's always going to be opportunities like that, right? I mean, it doesn't matter if that.
And that was on market.
Yeah, it doesn't matter if you're working with a house that somebody doesn't want anymore, or an apartment building that somebody doesn't want anymore. They're willing to take a little bit less in order to be done with it. So, we're looking for those types of opportunities. We're not looking for a Class A building that is perfect and the rents are at market. We're looking for something that's distressed. The rents are below market. It needs some work. Something's wrong with it, or the owner just wants out, right? The owner's 80 years old and they've owned it for 20, 30 years and they just don't want it anymore.
Is an 8 cap currently or pro forma 8 cap?
No, current. So yeah, we're not looking at. I mean, when somebody gives you pro forma numbers, it's just complete, nonsense.
Yeah, totally.
If it was pro forma and they could get it, they would, right?
Yeah, that's pretty cool. It's 8 cap currently without you guys having gone in and done your value adds. So
yeah,
that's
so
awesome.
when we're done, it should be around 10.5, 11%, which is good.
That's pretty cool.
Yeah.